The more I read about the collapse of Silicon Valley Bank, the more fascinating it gets. Why the fascination? After all, it is only one of the smaller banks in the list of top 20 US banks. Well, it isn't just about the collapse of a bank in the USA. It is about the suddenness of the collapse and how quickly the US authorities took control of the bank. Although it was only the 16th largest bank in the USA, the collapse has left billions of dollars belonging to depositors stranded. It has been estimated that 97% of these depositors have more than $250,000 in deposits each in Silicon Valley Bank. The FDIC is only able to pay each depositor up to a maximum of $250,000, as this is what the insurance covers. What this means is the prospect of massive losses, inability to pay employees and vendors. It could lead to a large number of business failures. This could speed up the arrival of a recession, which many experts expect to happen later in the year. Blame for the collapse of Silicon Valley Bank has been placed by many squarely on the Fed. The Fed's aggressive interest rate hikes in the last year has ramifications as it crimped financial conditions in the economy. The high-growth but loss-making startup space felt this the most keenly. Silicon Valley Bank, an entity which has been instrumental in the development of startups in the USA for the past 40 years, was a casualty. Startups had to withdraw deposits as their cash burn continued. Silicon Valley Bank had to sell treasuries, losing some $1.8 billion as the bond's market value had plunged due to the Fed's aggressive rate hikes. It is most likely that other banks in the USA are holding long-duration bonds which have lost quite a bit of value too. However, as long as their balance sheets remain strong, they do not need to liquidate these bonds. These treasuries are safe as long as they are held to maturity, when the holder will get back the full face value. Still, we have to be cognizant that the Fed's rapid tightening of financial conditions to control inflation could have undesirable consequences. This is even as we feel good about our local lenders' ability to do well. After all, the Monetary Authority of Singapore does not set interest rates. Singapore's interest rate is mostly imported from the USA. Banks have to borrow in the short term but make long-term loans to customers. With front end of the yield curve elevated, banks will have to face increasing pressure when it comes to net interest income. The banks in the USA are already in this situation. In Singapore, we see the banks hiking interest rates to attract savers. Although competition in the space seems to have cooled down, it is anyone's guess if the economy is going to weaken next. Singapore's economy expanded by 3.6% in 2022. The Ministry of Trade and Industry has a forecast of 0.5% growth on the low end for 2023 and 2.5% on the high end. So, our government is expecting a slowdown. The collapse of Silicon Valley Bank is a sobering moment. Things do go wrong when we least expect them to. Although DBS, OCBC, and UOB do not have the exact same problems which the US banks have, they have seen CASA deposits declining. Their funding cost will probably continue to rise, and if the economy slows down, their margins will very likely be squeezed. I am staying invested as I do not think DBS, OCBC, and UOB are going to implode like Silicon Valley Bank. Don't do a Chicken Little. The sky is not falling. However, I will wait for Mr. Market to go into a depression before I increase my investment in the banks.